Hey, everybody, back again. The Helpful Home Inspector back at you again with another weekly live show. Today, we've got two important people in the room. We got Mark Smith, which has been on the show many times. He's going to be a good co-host. And we have Bill Moeller from Bank 59. I always say Bank High Five. High five. High five. You go over to Bank 59, he'll give you a high five, okay? Got a great show today. We're going to be talking about a lot of cool stuff. We're going to give you a defect of the week, save a buck. We're going to give you a tip of the week. And our main topic today is going to be all about the basics of home lending. Something that, probably 80% of the America partakes in. Home lending?
Yeah, somewhere between 80 and 85% of people have a mortgage.
Of some kind, yeah. So important topic nonetheless, and we're going to get into all that kind of stuff. But today, let's start off our defect of the week. Defect of the week, coming up with deck issues. So very rarely do I inspect a home where I come across a deck that is done perfect. Very rarely. It does happen occasionally, but very rare. But when we come across decks that are just a little thing here or there, not a big deal. But when we come across a deck where you put 10 people on this thing is coming down, we have major concerns, because people, it might look good up on top, but you don't know what's holding you up. And you're having your bar mitzvah out there or whatever, and then next thing you know, we're going down the hill pretty quickly. So the defect of the week, this was a house that I was over at in Slinger, Wisconsin, and it's rough. I'll just get into it. You guys can see some of this stuff. Now, when it comes to your columns, okay, you generally want to notch the top so that the beam can rest directly on the column, okay? But you got to have the whole beam on the column, not just part of it. You also need to have through bolts. They should go all the way through the deck, and they should be substantial. They shouldn't just be leg bolts. Wow. All right?
Carriage bolts.
We also should have hurricane ties on here, not just a screw. Carriage bolts is better than what they got in there. Should be on a substantial base, not just a little 8-inch sonotube with a shim on the bottom of it. In this case, it looks like they kind of miscut the shim a little bit or something. But, yeah, you can't just have a shim there, all right? In this one, the one we were just looking at before, you can see we have a crooked column. Retaining wall blocks.
Yeah, I see that. Yeah.
Crooked column. We have a bowing crooked column, all right?
Wow.
Well, that's attached there. Come on.
Wow.
Piece of wood. Again, another little shim area. You can't do this, people. This is not how we build decks. So this deck is 20 by 20. Could not have been permitted. This could not have had a building permit pulled. On these beams and columns, not substantial enough, not secured properly, not working.
The cantilever on the outside is suspect.
Yeah. They gotta have that. Supposed to have it 2/3 in, 1/3 out. That's great. And inside, they didn't have a couple of nails. That's it. And I'm like, holy man.
Wow.
When you get into the underside here, you look at the bottom of this column. It's got a little shim on a too small of a sonotube. Right out. The beam is not.
Look at how tall it is off the ground, too.
Like it's supposed to. Yeah. They don't have any through. Like I could stand underneath this.
When that goes, that's a long way to go.
Okay. If there's a bunch of people on there.
Right.
Very obvious. You can see this columns are not doing what they're supposed to do. They had a problem, so they tried to shim one in there. I mean, my phone is not crooked, people. Okay? That beam and column aren't going to work. Wow. All right? We can also see the ones along the house over here, not even on the little 8-inch sonotube all the way, And as far as this all goes, yes, we're built in the hill, but you still need to dig down and get proper sonotubes in there and have proper securing to the structure, okay, for the columns and beams and stuff. And they just don't. We're just missing so many pieces here. And then when you get into the joist hanger,
where's the ledger board?
It's not attached to the house at all. They butted the end of the joist right up against the house.
It's just self-sustained, just on its own.
Standing on those 6 sticks you see coming down. Cantilever into the home. Those ones on the end actually went into the house, but weren't secured at all. But the ones in the middle, 1/3 out, 2/3 in. Never more than 1/3 out. Okay. That is a hot mess, and it was, needless to say, quite the eye opener for the prospective buyers. And I mean, it's a newer house. You're looking at a house built in 2006. So yeah. While I don't inspect for building code in 2006 existed. And in Slinger they have a building inspector that should have inspected that thing. So there was no way that was ever inspected or anything like that. It was not constructed by a professional, obviously. Wow. And it's the time of year where everybody's going out. And guess what? They want to build a deck, right? Decks are great. Decks are awesome. It's just that you need to do it the right way. Now, one of the things that you can do to ensure that you do it the right way, get a building permit. The building inspector is going to make sure that you meet the minimum standards for construction of that deck and making sure then that everybody going onto the deck is very safe. As you can imagine, somebody going onto the deck that we were just looking at, oof. I mean, if you're up on top, the railings look good, the balusters are good, it's nicely stained, the boards are spaced the right distance and everything, the railings are the right height, But the underside, what's holding up all that weight of all that wood, not to mention the people and stuff, it's like, holy cow, that's going to be a headache. But one of the downsides of being the home inspector that came in and inspected, I don't find out what happened afterwards. Right. I don't find out if somebody came in and made repairs. I don't find out what the cost of the estimate of the repairs were, or anything like that. It's repairable. I mean, ultimately, to fix that, you'd have to secure it in its position, and then you'd have to add in the elements that are missing and make some improvements. So not the end of the world, but still significant cost to repair. More significant if you don't repair it, though, and people get injured.
Especially with something that size, you'd think they'd want to overbuild, right? Like have it way more safe, I guess, for the amount of people that could be on a deck that's 20 by 20.
Yeah.
You could get a lot of people on that deck, and that'd be a lot of weight. So I don't know. It just seems like you'd want to overbuild.
And a deck can be a great enhancer to the value of the property,
Right.
But when you don't do it correctly, it's a detractor, So that is the deck issues defect of the week. Save $1 this week. Everybody's going out and getting out their outdoor lighting set up and stuff like that. Okay. Set it up on a timer. I can't tell you how many times I'm driving through the subdivision and somebody's night, your outdoor lighting and stuff is on in the middle of the day just because you're not paying attention to turning it on and off. Sure. It's too easy to forget. Just put it on a timer. Timers are cheap. They're not going to be very expensive. And while you spend $5 to $10 on that timer, it's going to save you $20, $30, $40 a month over the summer from leaving that light on all the time. So that is your save $1 this week. Now, co-host question, Mark.
Yes.
You have a new team member.
We do. Tanner Smith. We only hired him because he has the same last name.
That was a prerequisite.
It was a prerequisite, right. Actually, that's our son, Tanner. He is a UW-Madison grad, and he was in inside sales and saw the success that we were having and said, you know what, I want to become part of the team. He took his real estate exam. We are now currently waiting for his license to come in from DSPS, but he's excited. He's already talked to a lot of people that are in his sphere about what he's doing. Sure. And we made an announcement, obviously, but it's huge for us because of the fact that he's got a lot of experience with social media, technology, and he's a lot like his mom and dad. He's very competitive, so it's excellent to have him on board. Yeah.
And I mean, while we as 40, 50-year-old guys, okay, we are buying into the social media stuff. The under 30 crowd, they're like, it's entwined in them, know? And you look at his feed, he's probably got thousands of friends, and that kind of stuff. And his reach of people is going to be huge. But definitely reach out to the Smith team. Whether you contact Tanner, Mark, or Sheila, they're going to be good to take care of you on the real estate side of things. They'd be happy to help you out anywhere in southeastern Wisconsin, but primarily the Lake Country,
our license is for all of Wisconsin, but we definitely work in that quarter, that 83 corridor from Maguanago up to, let's say, Neshota.
Yeah. Awesome. That's great. Now, getting into our special guest of the day, Bill Moeller, Bank 59. How long have you been doing banking stuff, dude?
22 years.
22 years. That's a long time to be banking.
Yep.
Yeah, that's awesome. And all of it with Bank 59?
No, I started out with a small community bank called St. Francis Bank. That was, it was basically at a time before a lot of things went down in the banking sector. Yeah. You had, let's say you had a lot of buyouts that happened and acquisitions that happened. And eventually I came back to the community banking culture just purely because it's so much more holistic in the relationship and getting to know people on a first name basis. Sure. And all the things you associate with that type of experience. I worked for a national mortgage company for a while, got a chance to, deal with that type of a space and really feel like this is where it belongs.
It's a different world.
Where I belong.
Yeah, the large banks, man, it's so impersonal, and everybody's just a number. Where when you walk into your local Bank 59, they're gonna know your name. They're gonna know. They're gonna get to know you. Like when Tammy goes into, not to talk about another banker, but she goes into Landmark, they know her, and they all know her by first name basis. Yeah. So that has value. And when you have your banking decisions being made locally, it's just so much easier.
Absolutely.
To work with them. So Bank 59, if you're looking for any type of lending, you can look up Bank 59, but Bill, primarily mortgage is what you
Yeah, well, so new construction, lot loans, 1 to 4 unit properties. I'm doing investment properties.
Commercial stuff at all?
We do have an excellent commercial department. We're one of the best SBA lenders in Wisconsin. Sweet. And, it's surprising when you get to help someone buy a mixed-use property where they come to me for the financing advice, and I bring in a subject matter expert on that, get them a low-down payment fixed-rate mortgage for a commercial property where they've had limiting beliefs on whether or not they could get it done, and then create a client for life.
But then you got the experts in the room, too, to help you make those decisions, which is awesome. So cool. All right, now as far as rates, which anybody that is in currently hunting for mortgages or have a mortgage or anything like that, they are always concerned about the rates. What are we looking at right now on your conventional 30-year fixed?
Yeah, so there is a considerable spread in the way that we're looking at the way mortgages get priced today. Fannie Mae puts out these mortgage bulletins usually every month, and particularly they make some kind of State of the Union calls towards the end of the fourth quarter where they're going to basically change some rules. Mm-hmm. So what they did was they made it more cost effective for first-time buyers to get a mortgage by reducing what they call the loan level price adjusters or the surcharges. Think of it like you went to the airport, Matt, and your bag weighed too much, like maybe my wife's does occasionally.
56 pounds?
Yeah. And I calibrated the scale, honey. I swear it was right. And all of a sudden, next thing you know, that person who used to be able to get a 20% down, 740 credit score used to be the benchmark to get the best interest rate. Yeah. Now, for someone coming in, they need to have 30% down and be a 780 credit score to get the very best interest rate.
780 so is not easy.
Yeah, exactly. You got to be on top of your game, and you maybe don't carry a lot of debt. So to answer your question, interest rates, depending on all those factors, are in the mid to low sixes. Mm-hmm. And we are seeing first-time buyers getting in right now. And lenders have to be way more savvy about how they're putting those quotes together too, because there are some factors that dictate that. Sure. Low sixes to high fives for someone in that situation.
High fives. Oh,
yeah. And it's something where you don't even know what you don't know if you're not working with someone that's been trained on those programs.
Yeah, for sure. To be in that 5 to 6 range, that would be what I would consider normal. A normal interest rate. 3. Like some people, it used to be 3. That's not normal. We can't expect that to come back anytime soon, correct?
Absolutely not. Yeah. If you honestly took out 2020 to 2022, you would consider 6% a good interest rate, a median interest rate historically.
Yeah. Now, Mark and I, you guys talk about how's your phrase go?
As far as the 30-year fixed rate,
what is it? Marry the.
Oh yeah, you want to marry the house but date the rate.
Marry the house but date the rate.
That's right.
So this is kind of by the decades. So when my parents bought their house in the 80s, they paid 18% interest. It says 12, but they paid 18% interest for a 3-bedroom ranch in Appleton, Wisconsin. Okay. And like in the 2010s, we were in the 4s was the bottom end of it, right? That was the lowest that we really heard from the 2010 to 2020. And then 2022 happened, or 21, 22, we jumped into the 3s. And in some cases, even below 3,
Yeah, 2.75 I've heard.
2.75 I've heard in the past.
Yeah.
But incredibly, this was an old picture, obviously.
Sure,
it was 2.81,
I got a client that I did a 15-year fix for at 2 1/8. That was the lowest I ever did on a 15-year fix.
Wow.
And honestly, because of those low interest rates are causing part of the housing issue that we're having today that we talked about when we had Corinne on, in that these low interest rates, I have a really low interest rate. I don't want to move because then I got to take a higher interest rate and stuff. So it's holding people back from listing or selling their home, even though they potentially could make a whole bunch of money on it on the back end.
Yeah, I think it's a matter of perspective, right? So if your memory is only three years long, that's one thing, but the 30-year fixed rate since 1971 has averaged 7.75, right? We're not even close to 7.75 being that average starting from the early 70s. So I think the best thing is look at it on perspective and realize that 2.75 is almost like free money. It's like, hey, you want a mortgage? Here's some free money.
Yeah.
At 6%, I mean, we're talking just over what sales tax is when you buy something, right? So 5.5, right? So we're at 6.
Yep.
And I think that the general outlook, they're saying that it's going to be in the high 5s coming up toward the end of the year. So I think it's like anything else, it's all perspective.
Yeah, there is some really important dates coming up on the horizon for the calendar. One is going to be May 10th. You see the Consumer Price Index and the monetary policy with the Federal Reserve. They take a 12-month rolling average of this measure of inflation.
Okay.
And the there's a housing rental component to the inflation calculation that they add in, and that's the most impactful measure to the inflation reading. And there's when they drop off April of 2022 off the rolling average, we're going to see a significant improvement in the inflation reading.
May 10th, that'll disappear then, right?
Yeah, and there's going to be a move for rates, and a lot of the people in the mortgage sector, if you go online and you just search for that, you would see quite a few bits of content online about it.
Yeah. Now, before we get too far into the depths of the lending process, there is some terms that for those of you that are in the audience that maybe have never bought a house before, have never had a mortgage before, maybe in some cases never had a loan before. Mom and dad might have gave you your first car. Who knows? You need to understand some terms. And as we start talking about Fannie Mae, Freddie Mac, it's a government. They
government secured. They're in conservatorship ever since 2010.
Yeah. But they basically manage lending, and all the banks pretty much refer to them and.
They make the rules.
They make the rules for the most part. Okay. But one of the things that can be difficult for people to grasp is amortization. It's a big word, and it can be a complicated topic. So like when you look at an amortization schedule, this is an amortization schedule. There's another one. Does that make a lot of sense to you? And this is only the last 26 days of an amortization schedule. Bill's like, that's my Bible, man. But in reality, while it is very confusing, there is a common sense approach to what amortization is. You want to try?
Yeah, so basically an amortization schedule, and the way that I would describe it is it's a scale. On the scale, you pay more to interest in the beginning of the cycle. As gradually or time goes on, you will eventually pay more to principal. So, for example, if you took a 30-year amortization schedule at a 6% interest rate, for example, and if you are going to want a basic, really easy way to calculate a mortgage payment, a 6% interest rate is $6 per thousand.
Okay.
That means for every $1,000 it's $6, for every $10 it's $60, for every $100,000 it's $600.
Yep.
So as you get on a scale like that, you'd be 12, 13 years in, and then all of a sudden that level that you're paying to principal reaches the level that you're paying to interest. Mm-hmm. As time goes by, that scale gradually shifts so that now a substantial part of your payment's going to principal. And that's why you hear the proponents out there that you should be getting a 15-year loan if you can, or a 20-year loan, or you should, like we're going to talk about in a couple minutes, the advantages of paying a little extra.
Yeah. Do you want to bring the computer model up again, Tammy? So this is kind of explains how amortization works. So the blue part, that's solid blue there, is the amount of money that you loaned. So you loaned $250 from the bank, $250,000 from the bank. Your payment is the yellow line, okay, or the cost to you. And then the red line is going to be your interest that you're paying to the bank, and the little blue line is the principal that you're paying. In the beginning, you're not paying as much principal as you are interest. The bank's going to get their money first, generally speaking. Mm-hmm. As you move through that calendar of months, okay, then eventually what's going to end up happening is you're going to pay more towards principal than you would towards the interest.
Right.
At the end, your last interest payment is very tiny, and your big principal payment is very large. But that's kind of how that breaks down over the course of 30 years, which is a long time. Okay. As far as amortization goes, it just basically depicts that in numbers for you when you look at an amortization schedule. Yep. So you can see after month 243, this is what my mortgage payment is going to be, which is going to be the same throughout generally until you get to those like last couple of payments. Sometimes it changes a little bit, right?
Yep.
And then you're going to see how much was going to principal, how much was going toward interest, and that's kind of what that all lays out. The next term is underwriting. Now we talk about these guys like they're little trolls in a room someplace that nobody can ever talk to or see. Do they even exist? And Bill will tell you, yes, they exist. He's probably spoken with some at some point in time. But how do they explain underwriting to people?
Yeah, so basically, as a measure of risk, an underwriter is there to assess a few things. One, is the collateral going to be a layer of risk to the borrowing that person the money that they're going to get repaid. Yeah. Secondly is, you got a few other facets. You got assets. Where's your money coming from for your down payment? Is it gifted? Is it, are you power saving it right up to the closing day? Is it money that you had in a 401k? Where did it come from? Mm-hmm. The other one, of course, would be, and the big one is going to be income, because you have so many different types of income.
Oh, yeah.
Mark, you run into people probably that are self-employed. Have you ever had any cases where you had someone that maybe came in and you could tell kind of they're going to need some creative underwriting?
Sure. Yeah, it happens all the time.
Yeah, the creative underwriting piece happens when sometimes someone's self-employed and maybe they've only been in their new business for a year.
Sure.
But they had a history in that type of business before. That's someone that Bank 59 wants to talk to.
Yeah.
You have situations where someone is commission based, they're overtime, they have a part-time job. We got to look at all that
rental
stuff.
properties, everything
Yeah,
else.
we got to look at all that on a case by case.
Yeah, and that's really what the underwriter is. He breaks down all the different elements of where the money's coming from, making sure you're a good bet. Making sure the bank is worth betting on you. That you're not gonna...
compensating factors.
Yep. Okay, cool. The next thing, title. So title is not necessarily your job, but you guys both deal with the title company very closely.
Right.
The title, how would you explain the title, Mark? What is the title to a homeowner?
So title for the most part it's more of a concept of the fact that you have a physical piece that's called a deed. Deed is kind of a piece of paper that says that you are the owner of such property. The title is kind of like the concept that you own it and you have the right to do what you want with that property. So they're kind of tied together, but they're not the same. So deed is actually the actual physical piece that when that's transferred, that gives ownership to the person that you transfer the property to.
Sure. And the title company just verifies that the owner is indeed the owner and that it gets transferred properly to the buyer.
Correct.
Right. Now, in a car lending situation, the bank is listed on the title. In a
Lien holder.
mortgage, are you listed on the?
No, you're not listed on the deed, but you're listed on the it's called the title commitment. Okay. So you get a title commitment in the mail. You get the actual title work in the mail, usually 2 to 4 weeks after you close, and they record the deed in your name. And the title work is going to list who the lien holder is. It's going to list if there's any encumbrance or any easements. It's going to list the legal description.
Sure.
And then, like we have a case where someone's closing on a property on Monday. If there's any back taxes, if the seller didn't pay a contractor, if the seller got in trouble and maybe had a judgment, all that stuff, the title company is going to vet that out so that the buyer that's getting the property realizes the property with a free and clear title.
Yep. Okay. And there's usually title insurance that goes along with all that
Correct.
process, right? Yeah. The next thing, and the before we get into the lending process, is appraisal. Appraisal, again, is not your job nor his job, but you guys both deal closely with that person. Sure. I even bump into once in a while when I'm doing the inspection because they want to try to schedule it all at the same time. But what is the appraisal to you as the bank?
Yeah, so the appraisal to us is really a second set of eyes to make sure that there isn't any safety or structural issues, any deferred maintenance that's going to be a detriment to the value of the property. And then we're also looking at, of course, something that Mark could speak to a little bit as it relates to how you're going to determine the value. And then, the other thing would be you sometimes run into unique properties too.
Sure.
And we got to make sure that the appraiser can actually find like-style properties where the day comes where someone wants to resell that property, we're going to be able to get the transaction, put together where it gets sold.
Sure. And
I was just going to say that we use a lot of different home valuation models in order to come up with comps for our listers and also for our buyers that are looking at property. And it's always nice when you have the valuation systems. Let's say it's a 5-star system and it's 5 out of 5 stars. This is what the valuation is. That means that there's plenty of comps in that area. So if you find a neighborhood that has, let's say it's a single builder and they built all the homes in that area, and there's a record of, let's say, 5 or 6, 7, 8, 10 years of sales. Sure. You've got a really good track record because they're all basically the same homes. Could be 4-bedroom, 2.5 bath, and then we've got a really good comp model there. Where we run into problems with appraisal would be one-off properties, like Bill's saying. You've got like a large piece of property in an urban center, but there's nothing around it that's actually a home. You've got school buildings, you've got manufacturing, you've got things like that. That's where you might run into an issue with appraisals. Sure.
And the interesting thing that'll come in is when you have like someone like myself or Mark, where we're going to get tested, right? Like for example, there's a ranch property for sale right on Washington Avenue in Cedarburg right now. It's a 3-bedroom ranch, but the seller converted the garage into an office space that formerly was used as a dog grooming studio. And now it's zoned commercial, but they adamantly want to sell it as a residential property that someone's going to live in. Now you look at
going to the community and getting it rezoned.
Yeah, and what's in the proximity of that? There's commercial buildings on either side. You've got the street view. You have a lot of factors. That's going to be something that mortgage companies have to look really closely at, including Fannie Mae, because if that seller defaults, what happens?
You're stuck with the property.
Yeah, and then scratch and dent sale.
Yeah. Yeah. That's never fun for the bank to deal with either.
Anybody, right?
Yeah.
Good example.
Yeah, exactly. All right, so that is just some terms that are common. If you go to talk to a real estate agent or a lender about your home loan, those are terms that you're going to generally talk quite a bit about. Let's get into the lending process. The first step of the lending process, which we talk about almost every time, is the pre-approval letter. So the pre-approval letter, essential, okay? This is something you do probably on a daily basis, I would imagine. Okay, what is a pre-approval letter for those of you that have never done it before?
So to anyone that's actually looking to get started, there's these apprehensions. Am I going to be approved? Will I be approved for the amount I desire?
Yeah.
Oftentimes we see people put the carriage before the horse and they see the really fancy, shiny car in the showroom when in reality they should have been looking for one out on the used car lot.
Yeah.
And that metaphor really applies to the idea that you shouldn't start window shopping or set up a search with Mark until we had a chance to help you gather established credit, established assets, established income. For example, you can be fresh out of college, Matt, and you don't have to have a 2-year work history.
Really? With
your time in school is
nor a
treated
regular employment history.
Yeah, you have to have, if you have a college degree and you can show you have a transcript, you don't need to actually have a 2-year work history. They will treat that as work history.
So how do they count that for income then, though?
So basically, that person would be going into a profession where they're going to get salaried, or they're going to get a full-time 40-hour guaranteed work week with consistent income stream.
Yeah.
Where you'd run into trouble would be if that person was going to go and have a straight commission job.
Or be self-employed or something like that.
Yes, correct.
Yeah.
So pre-approval, just zooming out for a second just to come back to your original question, would be to basically say, we have a list of criteria that we have to check that we've been elaborating on a little bit a minute ago, and we want to meet that criteria on the pre-approval, and now lenders are having to go a step further. We're actually getting the customers through underwriting right out of the chute because
in the pre-approval process?
Yes.
Oh, okay.
We're collecting all the documents up front. We're actually going straight at it as if it's a real deal because we want that buyer to stand out in the space that they're competing with other buyers for the same property.
Sure.
And so if you have a pre-approval letter from the Rocket or somewhere else where it's honestly not really vetted as much as it could be. Everyone's going to be looking at these pre-approvals and scrutinizing them in the case where they have a lot of decisions to make for who they should select as that buyer that wins the bid on that house.
Yeah, the Rocket is basically just a computer vetting the person where you don't have any person's eyes generally.
I understand they can churn those up pretty fast.
Yeah. As far as the pre-approval letter, very important before you go looking at houses.
Yeah.
Right?
So one of the things for us is we always try to educate all of our buyers that come in. So we actually sit down with them. We have a meeting, kind of discuss what their needs and what their wants are. But the first step in our process is to get pre-approval, and we have our list of people that we choose. Bill is on our list of lenders. I can tell you that the biggest thing as being a listing agent on my side, if I'm working with a seller, let's say I get 5 offers, and let's say 3 of them are exactly the same and at the highest offer, but 2 of them are from a national lender, and 1 of them is from a local lender that is right down the block or is someone I can walk right into that office.
They can make decisions.
That makes a huge difference. And when we talk to the seller about that, I can tell you from personal experience of working with Bill. Bill's worked tirelessly. I know during weekends, like a lot of these national banks, they'll work from 9 to 5. Some might work during the weekends, but we always tell our buyers that if they are really, really connected with their lender, we ask them if you're really connected with them, you're going to need their cell phone number, because when we make those decisions and we have to get stuff that's done quickly, we're making our offers on the weekends, Fridays, Saturdays, and Sundays. Well, a lot of those lenders that are national are not necessarily working those hours. I know for sure that Bill is, because I actually had Bill talking with one of our buyers for probably 2.5, 3 hours on a weekend, and it was actually his birthday. So Bill definitely goes.
Talk about commitment.
Yeah, Bill goes out of his way to really help us out, and the idea of having a local lender is a big deal on the seller side. On the buyer side, for us, we need to know what those people can spend, because of the fact that we have to guard against them shopping too high, because let's say that theoretically someone's approved for $300,000. Well, in this market right now, you can't shop at the $300,000 mark because you have nothing to fight with, because a lot of these offers now are going above asking. Yep. Yeah. So what we say is, hey, let's dial that back down a little bit, maybe shop in the 260 area, 270, and then let's go from there, because you might be able to find exactly the same property, but not at be that top rate.
Yeah, that pre-approval letter is going to lay out what you can afford, generally speaking. And if you push the limits of that, you're pushing the limits of your pocketbook at the same time. Right. So you want to keep that within reason.
There's one other really big distinction I would make, and it's that all lenders right now have to literally go through a process where they're pre-approving a home seller that's going into upsizing or downsizing, basically at a two-facet process. Because basically, Matt, I'd have to say to you, if you and Patty didn't fall in a spot where you could get your house sold ahead of time, I have to qualify you maybe at a price point maybe that doesn't give you your full affordability potential.
Yeah.
Whereas if you get your house sold, obviously you can afford more. So to some lenders, there's criteria where they have creative ways to do it.
There's two sides of that then.
Yeah, and people have to get through that process without literally feeling like you've just got done running a marathon and you can't run another step, because if a lender doesn't frame that the right way, the way they weave in the two different approaches, someone could get discouraged.
Yeah. And if all you're doing is checking off boxes on a computer screen, you're not going to... You're going to feel kind of left on the wayside.
Yeah, so I think we both kind of work really well as a team to help people navigate through those feelings. And even when it was on my birthday and I'm talking to these people, vividly remember that conversation. They had that deal. They had that situation where they had to buy before they sell.
Yeah.
And you got to basically talk to people about pros and cons of temporarily borrowing against your retirement, hoping you have some money in reserve so that you could maybe make the minimal down payment and then also too wonder, what happens if I have two house payments? How long will that be
bridge
like that?
And all the it gets
or
hairy.
Bridge loans too.
Yeah, it gets hairy.
Yeah, so those are all things.
Yeah. Now, with a pre-approval letter, is it a requirement if somebody's paying cash? Like if I sold my house, I made $300,000 on it, and the house I'm buying is $250,000, and I'm going to pay cash.
Yeah. So if you're paying cash, instead of having a pre-approval letter, you'd have to have a proof of funds. So you'd actually have to go to your lender and get an actual document that's from the bank, not something that's made up of somebody's computer, but actually from the bank that's signed, that actually has a live person that's actually signed it that you can get a hold of, that actually shows that you have that money in your accounts and that it's liquid.
So a printout of my checking account won't work.
Not necessarily. I mean,
I would assume it's not.
Yeah, I think the thing is that we have to vet not only the document itself, but also the person standing behind that document to have a conversation with them. I know from our side, when we're listing a home, when we get offers in, we're calling every single one of those lenders and talking to them about the buyers that they have on their end that they're working.
You're underwriting basically.
We have to do what we have to do to protect our people.
Yeah, I mean the pre-approval letter, you're going to find that people that are if you're going to offer on a home, it's going to be a requirement. Nobody's going to list their house with a real estate agent that's going to accept any offers without some sort of a pre-approval letter or verification of funds.
You have to have that to have it be bona fide.
And most real estate agents, a lot of real estate agents won't even take you looking at houses without a pre-approval letter, because last thing, you go online and you go on Keller Williams, and you can look for houses till you're blue in the face or whatever, and find all kinds of cool houses that you would love to be in. And this real estate agent's going to chase around to 20 houses that you may never be able to afford because you don't know. And that's where this pre-approval letter is very, very important. So that's step one of the home buying process is getting that pre-approval letter.
They have to be ready, willing, and able.
Yep. Now, as far as the pre-approval letter, you're going to need some information. What kind of things do you need from them in order to establish a pre-approval letter from Bank 59?
We need 2 years of employment history, 2 years of residence history. We're looking for a summary of your liquid and non-liquid assets. So that would be checking, savings, 401k, IRA. If you got into Robinhood in 2020, we'll ask you for that. Sure. If you have crypto, that's also another really interesting thing.
You guys use that?
There are some specific set guidelines. In the interest of time, we won't go into too much depth on it right now. But basically, the distinction I would tell anyone that's listening to this podcast, this video, is the distinction of what's called seasoned funds. Seasoned funds is if the money's been in your bank account for at least 60 days. Mm-hmm. The mortgage lender, the underwriter, isn't going to ask you where the money came from. Yeah. The second that money appeared in your bank account and it's over 25% of your gross monthly income, and it landed in your bank account, I'm going to ask you to paper trail it in order for me to show that I can use it. So assets, I'm going to ask you for the 2-year income. I'm going to ask you for 2 years of residence history. That's a high level.
But no, so you're not really using crypto. Like if somebody says, I have $80,000 in crypto, you're like, yeah.
The rumor has it on the West Coast there is a mortgage lender that's not affiliated to Fannie or Freddie that will actually securitize crypto to make mortgages. Maybe years down the line that'll become more commonplace, but it's not really commonplace in the Midwest.
Red flag.
Yeah,
not something I'd want to work with.
And you have to actually liquidate certain assets in order for you to.
That makes sense. Like if you want to crypto account, you got to liquidate it, put it in your checking account.
Yeah, exactly. And then we're going to paper trail the liquidation of it too.
Sure. Yeah, to prove that it's legit funds.
Yeah. There are occasions where you can, get creative with how you're verifying funds and you can like gifts, certain things. But high level, that's what's going on.
Sure. Now, to get a pre-approval letter, how much does it cost a buyer?
Boy, if it costs anything, that buyer should call us.
That's what I would say. I don't think I've ever paid for a pre-approval letter in all the homes.
Lender wants to earn your business. They're going to take you through that process, be a good steward of helping you get educated, and make sure you get a pre-approval in a timely manner.
Yeah, I mean, a lot of when you're choosing the bank to go with, are you going to be able to communicate with the person? Are they available to you? Are they nice to you? Do they seem like they want your business? You know what I mean? And somebody that's going out there wanting to charge you $150 for a pre-approval letter is not somebody that wants your business.
Well, credit reports tripled in cost this year,
I bet.
at the beginning of the year. So some lenders it's starting to factor into their cost of doing business for how much a credit report costs now.
Yeah.
And
I don't know. I have feelings about credit reports and all that kind of stuff. How it would, they're managed by outside companies and they can make money off of my credit score. And I mean, it's just kind of a crazy concept, but it's reality.
They're going to get more regulated here coming up, and there's going to be some changes to the FICO scoring model by 2025. Right now there's 3 major credit bureaus: TransUnion, Equifax, and Experian.
Yep.
There is talk that they're going to eventually have some reform around that area. I won't go into more depth than that at this point.
Yeah, I mean, they're an outside business, so they have to be paid for their work and stuff. But we gotta, also keep it real. These are people's scores and stuff that you're making money off of. So, with that, as far as the pre-approval letter goes, when you get a pre-approval letter from a bank, is it a commitment to the bank at some kind or at some level?
It's really not a commitment in that there are still some facets to the transaction that could impact whether or not you go to a successful closing. You could have a title issue.
Okay.
You could have an appraisal issue.
Well, and you talked about starting underwriting as part of the process too, so that is even more in depth than just what used to be just a surface.
Yeah, and there are some lenders that are getting really creative in the way that they guarantee that you're going to go to a successful closing, or they will basically put their some dollars behind it.
Sure.
But basically, ultimately, from the standpoint of the vetting process, you get as far as you can ahead of knowing what's on title, ahead of knowing could there be something going on with the collateral, and you get that vetted out as best as you can.
Yeah, it's not an absolute commitment, but you got to look at this. This person is doing work for you at no cost to you, generally speaking. And I mean, while you don't actually owe them the farm, you do owe them a little bit of loyalty as long as they've gone out there and done the work for you. Just like a real estate agent goes out and shows you 40 houses. Okay, and they get paid nothing for showing you 40 houses. And then, I found my neighbor down the street that wants me to buy her house. And it's like, I just spent how many weekends with you? I mean, Mark, you got to know that's a thing. Here's the thing.
It happens. We do everything in good faith, right? The idea is that if you can help people and educate them and help them through, it's all going to come back at some point.
Yeah, exactly.
Yeah.
All right. The next thing we got to talk a little bit about is when, as a matter of the pre-approval letter, it comes in a digital form, or is it something you got to pick up the bank and get signed, or?
No, at this point, we're doing pre-approvals on the fly to the point where, let's say, Matt, you come to me and I'm able to run a credit report literally on the fly. I could be doing a pre-approval in the car.
On your birthday.
I have my laptop with me. I can do the pre-approval within minutes because I have the credit report. Obviously, when I say minutes, I'm able to check all the boxes and solidify all the details.
Sure.
So basically, an average pre-approval without exaggerating takes about an hour.
Yeah. And how long is it good for generally?
120 days.
120 days. So and you have 3 months or 4 months to go out and find your house.
And when we had a little bit more of the volatility, that 120 days, even though that's what the letter's for on the bank side, for us as a listing agent, we'd probably look for something that's a little shorter. So we might even ask for something that's a little bit more current because the volatility, when it's going up a half to a full percent, or then you're worried more about that, because if they're already at the top end and that interest rate went up another percent, we have to protect our sellers and say, hey, do you mind getting an updated pre-approval letter?
Yeah,
just to make sure, because we want to make sure that both sides know what's going on.
Yep. Well, and sometimes it takes a year to find your house in this current market where there's not as many houses available. It might take a long time. In which case, they just call you back up and say, hey, I need to update my pre-approval letter or whatever. I'm getting close to that 120 days. And I'm assuming it's a little bit easier, right?
Yeah, it is, because you already have everything in your system. Yeah. The sales cycle does cause us to fall into a place, though, sometimes where we have a customer that will be used to be, it would be 30 to 60 days, they'd be under contract. Sure. Now it could be anywhere between 6 to 12 months, depending on the client and their expectations. Yeah. And it could be Saturday night at 6 o'clock, and I'm saying to the person, I got to repull your credit right now, Mr. Customer. And all of a sudden, they maxed out their credit cards. And if I didn't repull their credit, I would be doing Mark's seller a disservice.
Yeah, because when you get to closing, you're gonna have a problem because
you're not gonna get to closing.
They verify they verify your funds and everything right up to the last day before closing. And if you screwed up and went out and bought a $80,000 car, that's gonna screw things up.
We always tell people they're gonna buy a vehicle between accepted offer and closing. You might want to make it a van because you're gonna be living in it.
Maybe down by the river.
Right.
Yeah. Now, getting a pre-approval letter, running credit scores mildly affects your credit score. Ish.
There's a common misconception that you can't go to multiple lenders, and to be impartial for the audience and just to, not have a bias, I will say you are allowed to shop for a mortgage. It says so right on the CFPB website. You can shop for a mortgage for 30 days and actually have multiple credit checks done by lenders, and it's only treated as one inquiry.
Oh, okay.
And as far as I can see, I see people that go and get multiple credit card checks to save money get a discount on your stuff at Macy's or whatever.
Kohl's or wherever, yeah.
Yep. Those are counted one for one. So you shouldn't see a drastic difference. If you do, it's going to be less than 10 points, and after 1 month, it'll rebound.
Sure.
The other thing too, we always say, well, what are you waiting? What are you holding onto that credit for? Because if you're worried about your credit getting nicked, well, what are you saving that credit score for? It's to buy a house, your biggest investment, right?
Yeah.
So.
Yeah, get in on it.
Right.
All right. So that is the pre-approval letter. Very important first step of going out and looking for a home, going out and looking and getting that mortgage process started. The pre-approval letter is essential. All right. Now, as far as the process goes, after you get your pre-approval letter, you're going to find your real estate agent. You're going to go out and you're going to start looking at properties. You're going to find that dream house, and you're going to put in an offer and hopefully get an accepted offer. Now, that accepted offer, while it doesn't always come as easily as we make it sound, it is a lot of work in getting there. So you may have to go look at a bunch of houses. You may look at a bunch of pigs with lipstick on it, but hopefully you'll find a dream house in that bundle. After you find that dream house, get that accepted offer, then you're going to make the bank aware that you have an accepted offer, and you're going to want to lock in your rate, right?
Yep.
Locking in a rate, how far in advance can we lock in a rate?
Generally speaking, 45 to 60 days. And the longer you ask the lender to commit to the rate lock, that will also cause your interest rate to be slightly higher in most cases.
Okay. All right, cool. And locking in that interest rate, you guys just guarantee that that's going to be the interest rate that you pay at closing as long as your closing falls within that window, correct?
Yeah. And a lot of times right now, customers are asking us if we can float down.
Oh, okay.
So that would basically mean if, let's say, interest rates go down a quarter, 3/8 of a point over the course of the transaction, it's popular for a good lender to be able to help the customer, educate them to know what makes interest rates tick. Right now, the 30-year fixed rate mortgages follow the 10-year treasury yield pretty closely.
Okay.
So like today, for example, on April 18th, the 10-year treasury yield was at 3.59 today. Okay. The lower the yield goes, the lower interest rates go.
Automatically?
It'll follow, it'll trend with it.
Okay.
So for anyone in the audience that wants to know like where rates are headed, you can look at the 10-year treasury yield. You can just Google it. You can go on CNBC, Market Watch. You can just pick one, and you can just kind of gauge that. That's a good way to look at it. But we're helping people understand how rates tick. Is there anything on the economic calendar that's going to influence the direction of interest rates?
Yeah. Now, all these things, you guys, are happening very quickly in the very beginning of you getting your accepted offer. So you have your accepted offer. You let your bank know you're going to get your lock in your rate and stuff. You're going to pay your earnest money, which back when we bought ours, we had to find our checkbook. I don't even know where I'd find it today. It's in a drawer someplace. But nobody writes checks for that anymore. It's all basically credit card usually, I believe, right?
Actually, we have a couple different ways we can do it. But basically, earnest money is traditionally between 1% and 2% of the purchase price of the property.
Yep.
So let's say it's a $300,000 house. Your earnest money would normally be about $3,000. If you want to make a really strong offer and up your earnest money, you could do that. Yep. It's due within 5 days of that offer being accepted. So you don't actually have to send the money money in when you put the offer in. It's when it becomes accepted.
Yep.
So you have 5 days, and that includes postmarked up to 5 days. So if it doesn't get there until the week after, but it's postmarked on that 5th day,
right.
you're still okay. But yeah, we generally now a lot of the buyers are using something called trust funds electronically.
Sure, electronic just transfer. Sure. And earnest money, you guys. If earnest money basically is if you back out of the deal that is no fault of the sellers and you just bail out on the thing, they automatically get your earnest money. It gets
I mean, it's
over to them.
pretty much. We always say it's got to be for cause, right? So there's got to be something with the contingencies that you already have on the offer. If you were to walk away, the one thing we did notice is that there are some sellers though that like the idea of having a mortgage versus cash buyers. There are some cash buyers that have so much cash that if they lose out on their earnest money, they don't really care. You always wonder if in that 30-day period they might find another property and say, you know what, I'll forego that. They can keep my earnest money. I'm going to go find something else.
Crappy because you made a commitment,
right? Yeah. But when you have somebody who's under a mortgage and they worked their tail off and they've worked with a lender and they worked with an agent and they said, hey, we're going to put this forward and we're going to get financing through a mortgage. Sometimes they're tied in a little heavier.
Yeah, and as long as everything goes as planned, that earnest money comes off of the balance that you owe on the loan. It comes off to your down payment.
So basically that money will go to the trust company of the listing agent. Let's say somebody made an offer on a home that we were listing. It would go to our Keller Williams Trust. It would sit there until closing, and at closing, it actually goes to the table, gets put into their down payment for the buyer.
Excellent.
Cool. Yeah, we're going to verify those funds too.
Yeah, exactly. And now after we've got the earnest money taken care of, you're going to get your inspection done, and then you negotiate any findings that come up as a result of that. The inspection thing has been kind of a little wishy-washy lately. Hopefully that will change as the market balances out, but we'll see what happens with that. And then you're going to get your appraisal done. Now, you usually want to have your bank wait until after the inspection and after that negotiating process to get the appraisal done, because if the appraiser goes in, you're spending that, what is it, $450 these days?
That's a good estimate of an appraisal cost. Yeah,
you spend about $450 on the appraisal, and that is your buyer's expense. It's not something the bank pays. It's not something the seller pays. It's something that you pay. And if that happened on a home that you get through the inspection, you find it had all kinds of foundation problems, whatever, and things didn't negotiate out, and the appraisal was done before the inspection, you're still stuck paying that $450 generally, right?
I believe as soon as they're doing the appraisal, they're going to be deducting that $450.
So the appraiser is going to charge a trip fee if they drive out to the property, and if they inspect it, but they don't actually deliver the report, they're probably going to still hit you for the full cost because they did the due diligence ahead of going out there.
They still went out there.
And we're also in situations too where the dates and deadlines on these transactions. I mean, we've got some deals that have to close in 14 to 25 days.
Holy cow!
And we got so day one could be a Monday, and we got to get the appraisal ordered right alongside the home inspection being arranged with you or something like that, and then we're gonna just tell the buyer this is what it is.
Yeah. So that is the appraisal. Then the title kind of. As soon as the accepted offer comes in, the title starts working on it, right?
Yeah. So a lot of times for our listings, we're using Focus Title, and they do a great job. But I always tell everybody when we're discussing the education of what the title company does, I always tell them it's kind of like the Wizard of Oz. It's like, there's something happening behind the curtain, but we're not really sure. They're doing a ton of steps behind a
30-year search.
Yeah, and they're doing all this due diligence and making sure they get making sure that there's no liens on the property, make sure that the deed's able to be transferred, all those things, all those steps that they're doing behind the curtain. We don't really see it, but all of a sudden they're ready to go.
We're going to find out. Yeah. We're going to have Sarah Weisman on the show in a few weeks or whatever from Lakefront Title. And we're going to get into it with her. I want to find out what they do.
They do a ton.
But so that's a important step is the title, but it does take a little bit of time. You just want to make sure that all your ducks are in a row by the time you get to closing. Financing gets confirmed through underwriting, usually a week before closing?
You hope you're clear to close at least 3 to 5 days before closing, because that's the last thing the buyer remembers is how they got to the closing table, that they didn't crash land the plane. You basically you could have scenarios where the buyer's getting a gift from, you get the trifecta. You got the buyer that is power saving a portion of their down payment, some other money is coming in from a gift, and you got work orders or repairs on the property where you got to get lien waivers and invoices. And all of a sudden you're chasing all this stuff down right up to closing day, and then the buyer is frantically hoping to get their final dollar figure. These are all things that we try to avoid, or we just try to be proactive
a lot of
about
stress
on the front end.
Yeah,
and you just make sure buyers understand up front what's all at play.
Yeah, there's a lot going into it. And then before you show up for closing, you always got to make sure that you secure your homeowners insurance, which we're going to have Dan McLeod from Colonial Insurance. He's a mortgage broker. He's not a broker. He's a insurance broker. He's going to come in here and talk to us about homeowners insurance and that kind of stuff, what they cover, how you get that, all that kind of jazz. So he's going to come in and talk about that. And before you go to closing, you got to make sure all these ducks are in a row, and that's really where your agent comes in. The bank's they're all communicating in the background, usually not necessarily with you, but they're all communicating to make sure that things go smoothly for you. So that's why it's important to have a good team put together, and they are a team. So when you go to the Smith team and you're looking at houses and stuff, they're going to give you recommendations for who to go work with, because they know that they have a good relationship with them, and they know that they're going to do everything they can to get that to go smoothly for you and come together.
Yeah, 100%. I think the idea of trust and communication, when you have something going down, you got everybody's best interest at heart. You're trying to make sure you're taking care of all those people. Yep. It's always good to refer to really good people and have really good people on your side. So,
exactly. Now, the next thing we're going to talk about the different loan types that we have available in Wisconsin. While there is more than what I've listed here, probably, it feels like that's a pretty small list, but it's a list of what the majority of loans that get pushed through contain. So your conventional loan, that's going to be your 30-year fixed loan, and that's what
most people associate with is a conventional mortgage, and those can be anywhere between 10 and 30 years in 5-year increments. Years ago, we used to do a 40-year mortgage, and depending on what happens with the landscape of interest rates down the line, you might start to see those appear again. Although they're kind of scary to me.
Jumbo loans and stuff, right? I mean, that's in the same range, right?
Yeah, it is.
How do you get such a big number now? I mean, your average loan back in the day used to be $200,000, right? Today, your average loan is probably $350,000.
It's in the realm of between $250,000 and $350,000, depending on the area, and the idea that you would have a loan where you would, if it's 12, 13 years to get to principal and interest breaking even, what would you think if I told you that it would take you 22, 23 years for principal and interest to level out on 40-year money, and whether or not that's a really good move to make? Maybe dial back the purchase price a little bit, keep yourself in a loan that you can pay off in a reasonable time frame before you're going to get your AARP card in the mail.
Well, and honestly, most people aren't buying their forever home. Right. When you're shopping around people, Mark knows, okay, yes, you may love this home, but you're only going to be here for 7 to 10 years. That's really the reality of most people, right?
Yep. Yeah.
So when you're looking at a 40-year mortgage and you're only going to be there 10 years, you're never going to make the positive side on that.
They're not super prevalent right now, but I wouldn't be surprised if you start seeing them again. The one distinction I want to make for everyone is how important first-time buyer programs are today. We do have some programs. You have the Fannie Mae Home Ready program, and then Freddie Mac has one. WIDA, which is in Madison, Wisconsin Housing and Economic Development Authority. They have some programs where literally buyers can do 100% financing, and they can finance their closing costs. They can literally come in with just the cost of a home inspection.
WIDA is Wisconsin only for those of you
state bond program
international watchers.
If you're not in the continental United States, or you're not in Wisconsin, you'd want to check and see if you have a bond program. Sure. That's what they're called.
Okay, cool. Yeah, and then a national program here in the United States is FHA. FHA is
HUD.
We used it for our first loan. I mean, it made sense. I didn't have to come up with 20% down because it was our first house. And I came up with 6% or 7%, whatever it was, and it
3.5% down is the minimum. The big thing about FHA that the Biden administration really helped home buyers by significantly lowering the cost of mortgage insurance. They lowered the cost of mortgage insurance by 40% from what it was last year.
Using those 3 dirty letters, PMI.
Yeah, private mortgage insurance. They lowered that cost. Folks who have under a 680 FICO score can go in and get an FHA loan and still get a reasonable interest rate, reasonable mortgage insurance. And FHA affords them that, provided that they don't have any issues competing in the market with other types of mortgages on other offers.
Yeah, PMI, for those of you that weren't around, it didn't really exist before 2008, right? Ish, or it might have been small, but we bought in 2009, and our PMI was outrageous. And about 4 or 5 years later, it kind of came back down to earth a little bit. We refinanced whatever and got it down to a reasonable amount, but PMI basically insures the mortgage for the lender.
So the lender gets, let's say that you go and you buy a house and you put 5% down and you're a first time buyer.
Yep.
The lender is insured with what they call 25% coverage for first time buyers. Okay. That means they're insured all the way down to 75% loan to value. The lender is protected if the buyer defaults, if the buyer tears the house apart, If the house goes into a big state of disrepair, the lender is protected, and that's basically what happens. You talk about what's going on in the Wizard of Oz. Behind the curtain, there is actually someone that participated in purchasing a pool of mortgage-backed securities that were sold on the secondary market on Wall Street, something like that. In fact, a lot of people outside the United States buy our bonds, and that's where the mortgages all come from. So PMI is a needed thing in order for you to not put 20% down.
Yeah, and while you're paying it, it is the bank's insurance. It doesn't help you other than the fact that you can get the loan because the loan requires it. So but PMIs
jumbo loans too. Yeah. You're starting to see some of those do less than 20% down, where they'll get some PMI on those, but a lot of lenders with jumbo loans want 20% down to do.
PMI really went crazy because of all the foreclosures and bad practices that were going on to the 2007, 2008. People were getting 0% down. That kind of crazy stuff was going on. And so that's kind of where it kind of got out of hand a little bit. But it's much more reasonable now than it used to be. So it's got a bad rap from what it used to be, but it's much more reasonable these days.
And something that we've been doing recently, the last 2 or 3 years, because of the fact that the home equity rate has gone up a little higher. So normally 4 to 5% per year you're expecting to get on your home equity to increase. The last few years has been more around 10 to 12%. So what we've been doing, besides having an agent for just buying and selling homes during that time period in between there, we're also helping a lot of our clients, our forever clients, and saying, hey, if you have PMI right now, we're going to let you know every year what your home valuation is. And when you get to that point where it could be around that 20%, we're going to send you that report so you can maybe go back and talk to your lender about, hey, our valuation of our house is over that 20%. Now we have more than 20% equity. We'd like to deduct it. We'd like to stop having to pay
Sometimes
PMI.
you may have to get a true appraisal to get that done, but the cost of the appraisal is going to save you a bunch of money still.
Another advantage of going with local servicing with a local lender, because you can get through that process a lot smoother compared to your call being answered in the order it was received and not knowing whether or not you're going to actually
computer,
whether or not, and honestly, they do not have a lot of reform around how they validate the process to remove mortgage insurance. It can be lender specific.
Now we do also VA lending is something I think Bank 59 does some of that.
We do VA loans, USDA loans, and FHA. They're all kind of part of the HUD family, Housing and Urban Development. The VA kind of is its own wing, but USDA and FHA have some parallels and a lot of the guidelines, like chipping and peeling paint and stuff like that.
Some of the same rules and regulations. Now the advantage to working with a local lender like Bill, would be you can go in and you can talk to him and, hey, this is our situation. He knows all the different modes of lending that's available to you, and he's going to find the one that works best for you and is the best to your advantage and your situation. As far as the available loans, there's just a small list that we presented here today, but no, there's a lot more of them that are available. What role does the credit roll play in the products available to you? Obviously, the higher your credit score, the better deal you're going to get.
It really took on a lot more prominent role this year. It's always played a role, but
that's some level.
But basically, conventional loans are available down to a 640 credit score. But the mortgage insurance companies still base their decision, like, let's say you and I and Mark go and get Corvettes, and I'm a habitual traffic offender.
Those new Corvettes are pretty sweet.
They are sweet.
They really look like supercars now.
But, I can't wait till the ZR1 comes out.
Oh my gosh,
yeah. But so hypothetically speaking, I'm the person that's paying the high cost of PMI insurance if I have a lower credit score, because it's no different than really your insurance for other things.
You risk.
Credit does get checked. It's considered a measure of risk. But we also fall into these situations where people don't even realize if you have 3% down, that also increases the rate of PMI. If you have below a 680 credit score, lenders should recommend FHA loans where the customer's not gonna really get taken to the cleaners on the cost of the mortgage insurance. I have had customers that had to got a quote for $400 for PMI.
Holy cow. Well, we do have Dan coming in a couple weeks, honey. When he comes in to talk to us about insurance, I really want to know what credit score has to do with my auto's insurance. Make a note. Okay. I'm just curious how this works.
It's a different type of credit report for them.
It is.
But still, nonetheless, it's considered a measure of risk for sure.
Now, as far as your mortgage goes. There is different ways you can look about paying your mortgage. You can just pay your regular mortgage payments every time. You can make an extra one every once a year. Anytime you make an extra payment towards your mortgage, it dramatically affects the end product that you're paying for, right?
Well, you're reducing the average cost of your daily cost of interest is being reduced when you make a large principal reduction. So a popular thing for you homeowners that are going to eventually sell and upsize or downsize would be to look at the idea that you're going to apply maybe some additional equity after closing, some cash after closing that goes straight to principal. Sure. You're technically reducing the effective interest rate on your loan by paying extra money towards principal every month, because the bank, it's messing up that amortization table for the banks for them to earn as much interest on you as they would have liked to have earned. So basically we see situations, to your point, where like we at Bank 59, we do biweekly payments. So that would mean that you're going to make 26 half payments instead of 12 full payments. The idea that you would make one extra payment per year. And that's going to, depending on the interest rate, it's going to save you anywhere between 4 and 6 years of payments on your loan. So you honestly, and I jokingly say this to my wife, who's also a mortgage lender at Bank 59. Hi, Stephanie. That the trips to Starbucks, all the other things that we're doing all the time, if you would actually make a concerted effort to measure where your money is going, and actually have that little bit extra go to principal. Take one, if you don't have the ability to do biweekly, go ahead and just figure out what 1/12 of your total mortgage payment is and add that per month.
Sure. Yeah, I mean, it makes a big difference in the end. Paying those extra payments once in a while is a good idea. Now, if I default on my loan, you're making a commitment. You should not default on that loan. But if hard times come or whatever, and you can't make your mortgage payments or whatever, call your bank, talk to them. It's the first step, okay? And figure out if there's options. Like the bank wants, especially a local lender, you can talk to them and figure, hey, I lost my job. I can't make my, but I'm gonna get a new job sooner. How long can I have? And try to work it out with the bank first, right?
Right.
But what happens if it just can't work out?
There's been a lot of reform around that ever since 2008 to 2010 as well. They had to get down to a place where once you fall 60 days past due on your mortgage, that's where the lender really starts knocking on the door. Yeah. And if you get into a situation where you had a financial hardship that was related to health issues or a natural disaster or something like that, the lender generally is going to work with you at first because they really don't want to take your house from you. Once you get over 90 days past due, that's where a foreclosure action is going to get initiated.
Sure.
And basically they're going to give you 6 months to make it right, usually, before they're going to start pursuing the action to the point where they want to try to take the property back.
I manage rental properties, and 5 days after they're late, they got a notice on their door. 15 days, you got another notice, and then 2 months in, we're going to court, people, and
there's and truthfully, whether or not we go into a recession in the next 6 to 12 months, this is a slow burn where some people, it could rip the Band-Aid off. If you fell into a situation where you got behind on your payments, and there could be continued reform around all that stuff. But at the end of the day, the investor wants their money because they bought those mortgage-backed securities.
Yeah, for sure. So you guys, that is a little bit of a nutshell of the home lending process a little bit. Yeah. If you want to learn more, call up Bill Moeller over at Bank 59. He'd be happy to help you out. His cell phone, his email address, his contact information is up on the helpfulhomeinspector.com. You can go on there and get his information. Otherwise, you can look him up at Bank 59. He's even got a cell phone number out there for the world to call him on his birthday. But he'd be happy to help you out. Give him a call, and he'd be happy to work with you and give you all of his knowledge to help you make your process go a little bit more smoothly. Now, we have a battle box. You've never experienced
First-time caller.
First-time caller for the battle box.
Long time listening.
Are you willing to participate in the battle box?
Enjoy the topic.
All right,
of the show.
Let's grab the 3 boxes here. Now, the way that this works, there are 3 contents here. We'll put them all in front of Bill. We'll let him choose first. All right. There are 3 contents here, and they are things that are in a competing space with each other. Okay, last times I used the plywood and OSB. Okay, so plywood and OSB compete against each other. Which one is better? And we kind of each take a minute arguing for our product. Okay, sure. And this is a product that you are going to have some expertise in, but which box would you like to take?
I'll do this box.
You'll take that one. Mark, I'll let you go next.
I'll take this one.
There you go. All right. Open up your box and let's see what you've got. There's a little pink piece of paper in here. I have a 30-year fixed mortgage. I'm going to argue for the 30-year fixed. Mark is going to argue for the adjustable rate mortgage, or the ARM, and Bill, you have 15-year rate mortgage. Now that is a fixed rate mortgage as well, but it's only
15-year
a 15-year fixed rate. Yeah. I did go on and did a little thing on Bank 59, so you can the second page has some of the current rates, I think is what they're listing is there-ish or around there. Just so we are talking the same numbers. So you don't have to use the numbers if you don't want to, but at least that way we're using the same numbers-ish, okay? As the new person, we're not going to make you go first. Mark, would you like to go first or second?
Sure, I'll go first.
Mark's going to go first, arguing for the ARM, or adjustable rate mortgage. Go for it.
So I think with the volatility of the rates, as they go up, as they tick up, if they're going to keep going up, adjustable rate mortgage is a great place because they become a little bit more attractive, right? Because the 30-year fix becomes like, okay, this is up 6, 7, 8, 9, 10%. Let's say that happens. Adjustable rate mortgage, you'll be able to get a discount on what you're paying on a monthly basis. You'll get it for, I don't know what a typical, what would you say are the most typical adjustable rate mortgage?
5 to 7 years, you're going to get a locked-in interest rate. You're still going to have a 30-year term.
So
what's that in compared to these ones?
Well, it varies. It varies on a lot of factors, but usually you'll save anywhere between, let's say it could be anywhere between 1/4 point to 3/4%.
Oh, okay.
So the best part about that is that you're gonna be gambling a little bit because the fact that 5 and 7 years you're gonna bet that those higher rates are actually gonna be coming back down. And like we always like to say that you want to marry the house and date the rate. So adjustable rate mortgages are great because you can take advantage of having that discount for that short period of time, that 5 to 7 years. And at that point in time, you can go back and you could sign for another adjustable rate mortgage, or you could actually do a 30-year fix or a 15-year fix at a lower rate at that time when they're available.
Change it up.
I would also say, too, that there is a bet here that people are going to be able to get a lower interest rate in the next 2 to 3 years.
It's a bit of an adjustable rate mortgage is a gamble of sorts.
Sure.
But it's all about your comfort level, just like with the stock market. Are you not comfortable gambling? You look at bonds. Okay. If you're comfortable with gambling, you look at the. Are
you risk averse?
Right? Yeah, exactly.
Crypto
exactly.
or stocks.
Exactly.
Yeah.
Crypto.
Boom goes the dynamite.
Yeah, that's exactly it. Now, basically, we each take a minute, and now I can just talk about 30-year fixed rate mortgages for my entire minute, or I can go talk against his or against yours and that kind of stuff. So I'm going to talk about the 30-year fixed mortgage, and the 30-year fixed mortgage is probably the most common loan product out there. Most people look at it when they're initially purchasing their home, and it probably is the majority of the loans in the United States at this time. And your 30-year fixed rate is going to be a little bit higher than the ARM. It's going to be a little bit higher than your 15-year fix, but it also allows you to spread out the money over that 30 years instead of a 15-year period. So your loan payment is going to be smaller. In the general world of things, if you're looking at a $300,000 house, your payment normally might be, $1,100 on a 30-year fixed mortgage. On a adjustable rate mortgage, it might be a little bit more than that, but depending. But your 15-year mortgage is going to be about $600-700 more than that. So instead of $1,100, it might be $1,600 or $1,700. So you're paying more money per month. Now you can then take that $400 or $500 a month that you're saving, invest it in the stock market, or do whatever you need to do with it, making that payment a little bit smaller for you. But it is stretched out over 30 years. I still could refinance it at some point if I choose to, but I know what my payment's going to be for the next 30 years. And with an adjustable rate mortgage after 7 years, what are interest rates doing? Are we going up to 12%? Ooh, now you got to refinance as quick as you possibly can, and refinance does cost money. I don't know how much Bank 59 costs, but
so your
costs something.
Yeah, well, without while I'm staying compliant, I will say that the closing costs depend on the program and depend on all the character traits. Do we have to use get a new appraisal, or can we use the existing one? Without paring it down beyond that, I would say that if you're risk averse, a 30-year fixed rate mortgage is a safer bet.
It's a solid way to go. Yep. Okay. That is my minute. You're next, man. What do you got?
Yeah. So my play for the 15-year fix would be a situation where I'm a downsizer. I'm close to retirement. I have a substantial amount of equity in my property. I talked to my financial planner. He says that I want to accelerate this debt and I want to make a conscious effort to get it paid down quickly. And those are the big plays for the 15-year money. Too often we fall into a situation where we give someone a 30-year loan and they swear on the Bible they're going to pay extra, but then all of a sudden that new Corvette comes out, and next thing you know, paying extra doesn't have as much luster as it did before. So the 15 years is going to lock you into that opportunity to really keep that interest cost low.
Yeah. Yeah. And honestly, Tammy and I went with the 15-year. That was what we ended up doing. And it's just to get our mortgage down faster. I mean, save on the interest in the back end of the loan and stuff like that. So I'm not going to pay the bank as much interest. My loan's going to be paid off faster. And we had, honestly, when we refied at 2.75, and we had already been in the house for 8 years or something like that. So we had a bunch of it paid down already, plus the value of the home skyrocketed and stuff. So it really worked out for us. But there's multiple ways that you can look at it. Put in the comments, which would you prefer? 30-year fixed, 15-year fixed, or an adjustable rate mortgage? We'll see who wins. We'll look at the end of the week.
Yeah, I think the best thing is they all have a place, right?
They do.
It's like having another tool in your toolbox.
Yep.
Interest rates go up, you got adjustable rate. You got interest rates go down, you got a 30. You're looking at a shorter horizon, like Bill's talking about. Let's say you're 50, 55-year-old, your kids are gone, and you want to buy an executive level executive ranch somewhere, and you only want to have 15 years because at 65 I'm retiring, right? I'm washing my hands. They want to be done with their mortgage as well.
And if you're prepaying that loan on a 15-year note, and you're really gonna drill it down, you're going to reduce that interest even more. You're going to get a comparable interest rate between 15-year money and the ARM. You're just going to lock yourself into that shorter amortization, which, like you said, is more expensive per month.
Yeah.
But for that person in the right situation, it's beneficial. And we do run spreadsheets for people, a very specific spreadsheet. I kind of nerd out on it, and it's one of my favorite things. I create something called a total cost analysis for customers, where at first I'm tailoring numbers around different price points. But then once I do their annual mortgage review, I'm going to show them the benefits of the different programs in the way. And we never put someone back to a new 30-year. If they had their loan for 3 years, I'm going to max out at 27 years.
Sure. So that they're coming out ahead on the back.
Yeah, because you don't want to reset it and sugarcoat the savings. That's not doing anyone any favors.
You reset it at 30 years, now you're giving the bank more interest money.
Yeah, and I just convinced you to take a 33-year loan on your house.
Yeah, exactly. So there's a place for it all. Talk to your lender. Find out what the best option for you is and for your situation, all right? Now, as far as the top 5 return on investment improvements, we're going to probably say that till next time, Mark. We're running a little bit long today.
Sure, yeah.
So we'll do that next time Mark's on the show. We'll talk about the top 5 return on investment improvements you can make to your home to increase the value of your home. We are, however, still going to give you our tip of the week. The tip of the week this week is dig out your window wells. It's that time of year, people. All right, so when we're looking at your window wells, okay, a lot of good inspectors will call it, that's just another point of water intrusion. And it is in a lot of cases, okay? If you have those old wood basement windows, not only is it a place for water intrusion, but it's a place for insects, rodents, all kinds of other heat loss. It's a lot of bad things happen in window wells, okay? So when you're looking at your window well, go outside. Your window well, the gravel that's at the bottom, or some cases, some people put a mulch or whatever down there, but it should be gravel. It should be 6 inches below your window, okay? So 6 inches below your window well itself, the metal or plastic casing that's around your window opening, that should be 3 inches above the ground so that water can't just run in there even if you have bad grading, okay? And then you want to make sure that there's no leaves, debris, all that kind of stuff in there. If your windows are the old wood style windows, while I would advise you to replace them, at the very least, prep and paint them so they're protected. If they rot, it gives an easy way for insects and stuff like that to enter into the home. Now, as far as the windows, if you have those old wood windows, look into glass block.
100%. I was just going to say, and the great thing about glass block too is that security, they're really good.
Yep.
You don't have to worry about those wooden panes. And then also they make the new ones now that actually have a vent, so you can actually get fresh air in your lower level.
Or put your dryer vent through it and that kind of stuff. Yeah,
sure.
Lots of options. But the glass block is going to be water impervious. It's not going to let water into the house, even if you do get a bunch of snow and water in there. Putting the little covers over the top, if it makes you feel good, go for it.
And a lot of times it's like a 2-day process. They come and measure, and they're in by the next morning. They're done. It's amazing how fast they can do that for you.
If you're in southeastern Wisconsin, West Bend Glass Block. West Bend Glass Block. All they do is glass block. They'll come in, they'll come out and measure your windows. They'll come out the next time, and they'll be in and out in no time. And they do it super cheap. Last I heard, it was like $150 a window for your normal window. But don't quote me on that. Call up West Bend Glass Block and get an estimate. But lots of great options there with Glass Block as far as venting, dryer venting, water intrusion, all that kind of stuff. Really a great idea. Now, as far as our show next week, we got co-host Mike Severson coming in. We're going to be talking child safety in your home. We're also going to cover 2 subtopics, which are going to be 5 early spring home maintenance items that you need to do, and to flush or not to flush? It's a good question, right? You're curious.
Courtesy flush.
Courtesy flush. Well, yeah.
Depends if you're playing poker or not.
Depends on what we're talking.
You want to flush if it's that.
Yep. It's called a teaser. So we're teasing the audience. Come on back next Tuesday, all right? But lots of great stuff here today, you guys. If you have interest in getting a mortgage or looking at a home, talk to these two guys. Mark Smith is your real estate agent. Give him a call. Smith Team Wisconsin. They're on our website, but you can also look them up on Keller Williams. And then also Bill Moeller from Bank 59. If you're looking for a mortgage, talk to this guy. He's local. He's here to help you out and advise you. And even if you don't decide to go with him or whatever, he'd be loving to talk to you and give you some of his information that he's got in that big brain of his. Any last comments, guys?
Go with Team Smith. Make your dreams a realty.
Ooh, he's got a tagline.
Better believe it.
Bank 59, making lives better.
Nice. Yes. All right. That's the show for today, you guys. Thanks again for tuning in. This is the Helpful Home Inspector, Matt Yates, coming at you live from Hartford. We'll see you next week. Have a good one. Remember, you guys, the better you take care of your house, the better it's going to take care of you.